Greetings and welcome to our next class that we're going to be talking about in taxes. My name is Kevin Matthews. I am the tax professor. Remember, class is still in session because the learning never stops. And essentially what we're going to talk about in today's class is tax consequences of debt discharge income. And so here's what happens. And look, I get it. As a person, I've had my ups and I've had my downs about various financial days, and there's been certain times where I'm kind of like, hey, things are really tough, blah, blah, blah. I've been very fortunate. I've never been through a bankruptcy. I have had a couple times where things have been really tight, especially a small business owner. It happens to all of us, is what I'm trying to get at. There are certain times where you kind of just say, look, I can't do this. And it's kind of funny because not last year, but the year before, we actually had quite a few of these cases where people were just saying, hey, you know what? I went through a service, got my credit card interest, my credit card balance is all written off, and what ends up happening is that they could end up with taxable consequences. I had 2 or 3 times where a client ran into this. They had to pay taxes on the discharge of the debt. I've had a few times where it's actually come back and we've basically said, no, we didn't have to pay up the tax, and we'll kind of go over some of that stuff. So not all canceled debt is going to trigger taxable income. There are certain exceptions that you can qualify for, of course, if they apply. The general rule is that, hey, look at it this way. When you go to a bank and you say, I'm going to go buy a house, and I want to buy a house for, $150,000. And you buy that house for $150,000. And if you're watching this video in the Washington, D.C. metro area, I realize that $150,000 probably wouldn't buy you a tool shack. Outside of the DMV, $150,000 will buy you an okay house, okay? I'm trying to Americanize my videos here. But the thing is that if you go out there and you borrow $150,000 to buy this house, how much tax do you have to pay on that money that you borrow? None, right? I mean, that would be ridiculous if you had to. So when you pay it back, obviously, you don't get a tax deduction off of the money that you pay back. You get a tax deduction on the interest that you pay, but not on the principal and the loan. So now here's what happens. You borrow the money to buy that $150,000 house. Halfway through, now we'll say that your balance is at $75,000. You can't afford to make payments anymore for some reason. You lost your job, got disabled. There's tons of reasons that you maybe can no longer afford the house. So you go back to the bank and say, I can't afford it. And they say, okay, fine, we're going to foreclose on you. And then you say, forget it, I'm going to go through bankruptcy. Or I want to discharge this entire debt altogether. And generally speaking, with a house debt, they're not going to. I mean, the amount of money is just too great. They're not going to be able to do that. However, if you go through bankruptcy and the judge basically says, no, I'm going to discharge this debt through bankruptcy, he can do that, or she can do that. And in that case, there's, again, that could, without congressional action, as we're going to discuss today, could trigger taxable income to you, because effectively you've walked away with $75,000 that you don't have to pay back, and you still have the house that you live in. Okay, so let's look at it from a perspective of credit card debt, though. I go out and I spend, $10,000 on, business equipment. All of a sudden, I can't pay that back. I go to the credit card company and say, sorry, no money. And they basically say, okay, we're going to discharge this. Then what they're going to do is they're going to send me a 1099-C, which basically will say, hey, we discharged $10,000 of income. You now have to pay taxes on that $10,000 of income. But again, there are certain exceptions that will apply. So, exceptions of the cancellation of debt is by a private lender, such as a relative or friend, it is considered a gift, and there is no income. Likewise, a debt canceled under a private lender will trigger no income to the borrower. Okay, so a private lender exception is one. There's also certain exception for student loans. For example, doctors, nurses, teachers who agree to serve in rural or low-income areas in exchange for cancellation of debt will not have to pick up any of the debt will not have to pick it up as income. And also from 2018-2025, there is a discharge of student loan on account of a death of a student or permanent disability of the student. The amount of discharge will not be included in the borrower's adjusted income either. One thing they don't put in my notes that I have here is also, and I'm only bringing this up because I'm a veteran, if you get your debts canceled as a result of becoming 100% total and permanently disabled, that is also not included in income here. I've had to look that up for 2 other people already, and so I know that it's something that I've had to look up. Keep in mind, there is no income from cancellation of debt that was deductible. For example, if a lender cancels a home mortgage interest that could have been claimed as an itemized deduction on Schedule A, there's no tax problem to contend with. Price adjustment. If there is no income of an individual purchases property and the seller later reduces the price, instead the purchaser's basis is actually reduced. So what ends up happening is, and this can actually happen if you end up having real estate debt discharged. You can have a basis adjustment done on it instead. So what ends up happening is, and we haven't really gotten too much into basis yet, we're going to talk about it in another video, but basically if you buy something, say I go out and I buy a house for $150,000, my basis in the house is what it cost, $150,000. If I do any improvements to the house, that adds to the basis. If I take any depreciation because I'm doing rental property, that decreases from the basis, and so on and so forth. So you can actually take a basis reduction for any debt that ends up being that was triggered to be written off against a real estate property. So that actually can end up working out very well for you. Exclusions. There are certain, in addition to the exclusion we mentioned before, there are certain other exclusions that are allowed. Discharge of debt through bankruptcy. So my example, where you go through bankruptcy, you're not going to pick that up in income. Okay, you went through bankruptcy. Discharge of debt of an insolvent taxpayer. Insolvency and bankruptcy are not the same. Okay, bankruptcy, you actually went to a judge and said, no money. And the judge looks at your assets and says, you're right, you have no money. You can't afford to pay these certain things. And so they may discharge some of that debt that's going to end up happening with that. Oftentimes, especially now under the new bankruptcy rules, what they try to do is remodification. And the modification could trigger income if these rules weren't in place either. But of course, it doesn't because it's subject to a bankruptcy. Discharge of debt of the insolvent taxpayer, however, I'm sorry, I almost forgot. Insolvency is actually defined as where you actually owed more than you're worth. Okay, and you just have to be able to prove that. It's a little more loosey-goosey. It's a little bit more difficult. I would never, ever, ever, ever try this on the old adage, don't try this at home, folks. Don't try this at home. If you are in that circumstance, go hire a CPA, EA, or tax attorney that can help you navigate those waters and get you past that, because you want to make sure that gets done. Discharge of qualified farm debt, discharge of qualified real business property debt, and qualified principal residence debt. However, it had to have occurred before January 1st, 2018. What happened is with the 2008 market crash that took place, Congress enacted bills that basically said, look, if you lose your house because of you're not able to pay your bills anymore, we're going to go ahead and you're not going to get charged tax on that. Okay, that would be kind of, number one, you lost your house, because usually what would happen with these houses is that they're actually going through foreclosures or they're going through short sales. So first of all, you've lost your house. You probably, that's already stressful enough as it is. Add on top of that, hey, tax bill. Okay, so they went ahead and they got rid of that. Congress has been trying to get rid of this exclusion for a while because, let's be honest, the real estate crash actually happened in 2008. It's been 11 years, so there's not been a massive sort of American crisis as a result of the real estate market. So I don't think I think that's probably the reason, the main reason why they actually ended up doing that. These exclusions, I'm not going to lie to you folks, are complicated. Okay. If you are not financially savvy, I would not try this at home. Okay, and especially if you went through a bankruptcy, there's probably certain rules and laws that you may not be aware of, that you probably need somebody who actually has tangled with this before. I have multiple times. I'm happy to take any questions or comments. Obviously, in a subject area as this, I would expect it to probably be a one-on-one conversation. I'm happy to do that, to kind of talk about some of the nuances of it, and all that stuff. You basically, you're going to get a 1099-C if you get this happen to you, and then if one of the exceptions doesn't apply, you'll have to pick it up as taxes. If you disagree with the amount on the Form 1099-C, and I have seen this happen before, where they get the 1099-C and the amount of money that is discharged on the income is way off, and they go back to the person, and of course the credit card company, who just lost a lot of money on that person, says, you know what, we have no interest in getting that thing fixed. There's actually recourse that you can do with that, but you got to talk to your CPA or tax attorney, and we can go ahead and take care of that. And there's ways to take care of that on the tax return that we know about, so we'll help you out with that. That's pretty much all I got to say about this. I hope, guys, you don't have to go through one of these. Every time I've dealt with clients who've had to go through it, it's an emotional thing. Nobody in the United States likes to be, that person who says, I couldn't pay my debt that I owed. That's never a good feeling to have. I completely empathize with that, and I've helped a lot of clients get through it. And I pray that this is not a video that you needed to see, but if you do need to talk to somebody about the tax consequences of this, please reach out to me. Again, my name is Kevin Matthews. I am the tax professor. Class is still in session, so learning is not going to stop. Go ahead and leave a comment in the comment box below if you have any general questions you want to ask me. If you want something more direct, you can go to my website, www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. If you like this video, please go ahead and hit the like button. We'd really appreciate that. And if you like this series, please go ahead and hit subscribe. We're trying to get our subscription numbers up so that we can spread the message of, and nail down this tax ignorance that I think a lot of people in the United States have. Again, thank you very much for watching this video.